Welcome everybody to the Texas REIAs. My name is Phil Grove. Let's start the recording. There we go. My name is Phil Grove. I'm one of the co-founders of the Texas REIAs. The Texas REIAs is the largest network of real estate investor associations across the great state of Texas. We've been doing this since 2003, so it is a vast organization with over 100,000 members, participants, and attendees going back for over 20 years. The Texas REIAs provides resources for Texas real estate investors. We're the only organization that lobbies on behalf of Texas real estate investors to make sure the laws are good for real estate investors. And we have over 1,000 private money lenders. We have a vast network of people buying and selling and wholesaling. We provide market updates, training, and more. And we're going to do some of that tonight in our meeting, including a market update. So we're going to go through a detailed market update and tell you what's going on in the market. So in general, let's start this conversation off. In general, what would you say the story is when it comes to real estate? What's the story right now? Well, what's going on in the market over the last year? Interest rates. Okay, so interest rates have changed. Who would say we have high interest rates? Raise your hand if you would think we have high interest rates. Okay, who thinks we have low interest rates? Who thinks we have low interest rates? Look at that, we have a mostly high. Now, for some reason, this side of the room did not vote, okay? So we're gonna give you another chance. You're all here, right? Who thinks we have high interest rates? Raise your hand if you have a high interest rates. Who thinks we have low interest rates? Low interest rates, okay. I would say it depends. My opinion, my perspective is we have normal interest rates. That's what I believe. I've been doing this since 2003. Most of my rental properties 20 years ago that I still own, I got was 6.5% to 7.5% mortgages. That's still have that. I mean, that's called normal, folks. That's called normal, okay? Now, in 1981, interest rates on mortgages got all the way up to 18%. 18% on a mortgage. If you were investing since 1981 and you saw you could get interest rates at 7.5%, you'd be like, holy crap, this is the cheapest mortgage ever. So who thinks interest rates are high? Well, if you've only been kind of paying attention, or if you bought a house in the last 2 or 3 years, you're like, oh, well, it was 3 or 4%. Now it's 7 or whatever percent. So it's perspective. It is perspective. 3, 4, or 5% mortgages, that's not normal. 4% mortgages, 3% mortgages, that has not happened in your prior life or your parents' life, okay? I seriously doubt that will ever happen again for the rest of your life or the rest of your children's lives. Could it? Anything could happen. I have no idea. But there's a million things that say it won't. I can't think of anything that says it will. That was a freakishly abnormal, once in 100-year phenomena. You were there, you lived through it, you saw it. Will it ever happen again? I doubt it. It might. I don't know. I can't predict the future, and I don't claim to. Although we'll give you some forecasts, but we don't know. But I would say, perspective-wise, I would say interest rates are normal. And honestly, personally, I like normal. I don't like abnormal. You know, the problem with the interest rates a couple of years ago, especially like in commercial real estate, there were all these deals in commercial real estate. I do commercial, I do residential. And the problem is, first of all, it's hyper competitive. So when it's hyper competitive, people do deals they shouldn't do because it's competitive and they want to do a deal, so they get motivated and they do a deal they shouldn't do. And some of these deals were put together in a way that the only way these deals could possibly be working is if they could get some ridiculous 3.5% mortgage. And they got a 3.5% mortgage, and they made these deals that were really not very good deals work. But commercial loans are not like residential loans. Residential loans are 30-year loans. Commercial loans are typically like 5-year loans. So those loans come due after just a few years, right? And now all those loans are coming due. And those same deals, right, that only worked, right, in this freakishly abnormal world of 3.5% mortgages, now they don't work anymore. So the big word in commercial is cash call, right? They're having to raise more money to pay down those debts, loans, to keep those deals from going under. So there's a lot of turmoil in commercial. I would say commercial, the best time to get in commercial is now. because now things are normal. You get deals that are not stupid deals, and with normal financing, you make things work in this market, right? You're going to have a good deal that actually works in a normal market. So I actually like that. But that's a perspective, right? Interest rates are normal. It's just my perspective from being a 20-year real estate investor. Now, let's talk about interest rates. When interest rates go up, what happens to home prices? Who thinks when interest rates go up, home prices go down? Who thinks when interest rates go up, home prices go down? Who thinks when interest rates go up, home prices go up? Yeah, look at that. We got a mix, huh? And a lot of you guys over here are still not voting, so I'm watching you guys. Yeah. Okay. I would say that when interest rates go up, home prices do this. They go up and they go down. There's both upward and downward forces on real estate. Okay, like I'll give you an example. Why are interest rates higher? Right? Because we had something happen. What else happened? We had something called what? Called inflation. What's another word for inflation? Appreciation. Yeah, I love inflation. It's always offensive to me when they talk, oh, inflation is bad. I disagree. All my money's in real estate, so I love inflation. I just call it appreciation. Right? It's just a different word. Appreciation means prices are going up. Right? So that's an up thing. We also have money. It's a little harder to get. And because it's a little harder to get, you know, in 2002, 3, 4, 5, 6, 7, we had subprime lending. Subprime lending. Anybody could get a loan. If you wanted to get a loan in 2007, you walked into a bank and you said, I want a loan. And somebody would walk up, they'd hold a mirror under your nose. If they saw fog, you got a loan. That was the loan application process. The stated income loan. It was the dumbest idea ever. They literally would say, can you pay us back? Yes, I can. Loan approved. I mean, it's like no doc loan. It was stupid. And surprise, surprise, in 2008, the banks went bankrupt. You know, they all went under. And, you know, the government actually changed the definition of bankruptcy. Did you know that? All that mark-to-market stuff. But they went bankrupt. By any real accounting, they went bankrupt. But they were too big to fail, so they got bailed out. But what happened up until 2008 is that money was easy. Anybody could get loans. All you had to do is ask, and you could borrow all the money you want. And so consequently, builders built houses off into the horizon in every direction. They just built bazillions of houses, tons of supply. Okay, and then what did they do with all that stuff? They just sold it to everybody because everybody could get a loan. Subprime lending, everybody could get a loan, everybody could build a house. So we built bazillions of houses, and then we gave away practically free money to everybody. And then in 2008, lending came to a stop. It didn't slow down. It's like the train hit the wall, right? It just stopped. And so all of a sudden, nobody could get a loan, right? But they still had all those houses, right? Incredible supply, and then demand just stopped. And what happened in 2008? Crash, right? The market crashed. Now, they were too big to fail, right? The banks got bailed out, and eventually they got back into the lending business, right? But all these years later, today, money got cheap, but it never got easy. Money never got easy after 2008. Today, what do you have to do to get a loan? Qualify. Fill out a 1,900-page application, turn over your firstborn, right? Submit your blood samples. A lot. You have to do a lot, right? You know, and consequently, even though money got cheap for a while there, it never got easy. And because it never got easy, we have not been keeping up with the demand. In fact, on a national basis, did you know that we are in the middle of a housing shortage? Who's heard that? We're in the middle of a housing shortage. Yeah, we don't have enough houses. Nationally, we're about 6 million houses short of the demand rate. And when you don't have enough supply, right, people keep having babies, everybody needs to live somewhere, and you have a housing shortage, what does that do to home prices? Pushes them up. So there's another push up. So we got some things pushing prices up. Now, at the same time, yeah, interest rates went up. And when interest rates go up, houses become less affordable. They do. And so fewer people can afford the house, right? So you have less demand, and that pushes prices down. So we have things pushing prices up, and we have things pushes prices down, right? And I'll show you in a minute when you put all that in the blender what's actually happened and what's going to happen next. But this is an interesting chart. This is home prices, median home prices versus interest rates going all the way back to 1975. So from 1975 to 1981, interest rates on mortgages got all the way up to 18%. Isn't that crazy? And you guys are complaining about 7.5%. Give me a break. Right? And by the way, when interest rates went up, what happened to home prices? Net, they actually went up. And when interest rates came down, what happened to home prices? They actually went up. And when interest rates went up and down, up and down, up and down, what happened to home prices? They went up. Now, there were little bubbles in here, right? So there were some little bubbles in here, but over time, they went up. So there's actually not direct correlation between interest rates and home prices. Interest rate does affect the number of houses sold, but it doesn't have as direct of effect on the price of houses, so because it pushes up and down at the same time. So interest rates have both upward and downward effects on the housing market. And when you put all that in a blender and you spit it out, where are home prices today? And the answer is they are flat. They are pretty much flat as a pancake, flat as Houston flat. So, and I'll dive into the different cities, but Texas, average price house in Texas, year over year, up 2%. I call that flat. The market actually bottomed out about a quarter ago. It's creeping back up a little bit depending on which market you're in. Average price is flat. It's not doing anything. Now the volume's down. The volume is down. Less buyers, less sellers, so fewer houses being bought and sold. But recently, it's picked up. So something happened about a quarter ago where the market kind of got to a plateau, leveled off, and now it seems to be creeping up again. But overall, I would describe the market as flat. And flat as a pancake, flat as Texas is flat. Now, let's go into where the different cities are and then where things going next. So there's different things that drive prices both up and down. And we'll give you a forecast, but I'm also going to tell you the disclaimer, we are not part of the National Board of Realtors. If you ask the National Board of Realtors what's going to happen to home prices in the next year, what will they tell you? They're going to go up. And they've said that every year for the last 50 years, right? Oh, it's going to go up. They just changed why it's going to go up, but it's always the same forecast. I have no motivation to try to persuade you that prices are going to go up or down or sideways. We have strategies. We're not selling you anything. We're not asking you to invest in anything. I'm not here to try to persuade you of any particular opinion. I'm going to share a bunch of data. We will give you a forecast, but we're going to tell you, you can make money in real estate, up markets, down markets, sideways markets. Sometimes the down markets are the most lucrative for real estate investors. But let's talk about what's driving the market. The first thing is the overall economy is actually pretty good, right? The economy is in a growth cycle, and Texas is growing at 5%, which is a little better than the national cycle. And so that's a good thing, right? When the economy is good, generally that's a positive influence on the housing market. Consumer confidence is actually pretty good. You know, when you ask consumers what their confidence level is, anything over 100 is considered confident. Under 100 is considered not confident. We're at about 115 right now. So consumers feel pretty good. They feel like, you know, they got money and they're not too worried at the moment. The unemployment rate's pretty good. That's another positive thing. Anything below 5% is considered really good unemployment numbers. The U.S. is at 3.7. Texas is at, 4? I can't quite see that. About 4%. Then we have different things in the different cities. So we're about 4%, right, for the unemployment rate. Anything under 5 is good. So the unemployment is pretty good. So that's another positive driver. Job growth, also really good. We're creating a lot of jobs. U.S. is growing at 1.7. Texas is leading the U.S. And growing at 2.6. The different cities vary a little bit, but strong growth. So that's good. Stock market's pretty good, right? And this has to do with how people feel. If people have their money in a 401k or IRA and they have that money in the stock market or personal money in the stock market and it goes up, they feel richer, right? Wealthier, better off. And yeah, last year, 2023, was a bang up year, right? Ended up really high. So everybody that had money in the stock market felt like, ooh, it's a bear market. I'm sorry, a bull market, and they feel really strong about that. Now, interest rates, here's a down, right? Interest rates are higher, much higher, and that has reduced the affordability. So there are people that couldn't afford or could have afforded a house before at the lower interest rates, but can't afford a house now. So that's something that's pushing prices down. Now, I will say the smart money believes that interest rates will probably go down this year. The consensus from the economists is that it'll probably go down about 1% starting in the summer. We don't know, right? Nobody knows exactly what's going to happen, but the forecast is it's going to go down. Some people say it's going to go down a little. Some people say it's going to go down a little more. I don't know anybody saying it's going to go up, right? So the consensus is we're probably going to see a decrease in interest rates. And of course, if the interest rates go down, the affordability goes up, and that will cause some upward impact on house prices. Home price trajectory is flat, right? Market kind of leveled off. Some cities went down a little bit. Some cities just kind of flattened out. So it's kind of a neutral, right? The market is flat. This last year was pretty much a flat year. Prior 3 years, up, and then flat. Closed sales trajectory. The number of houses sold is down a little bit because there's fewer buyers and fewer sellers. But something really interesting has happened with the houses that are selling. So let's talk about that. The mix has swapped. The mix has changed. Traditionally, if you look at houses for sale selling on the MLS, traditionally 2/3 of the houses that get sold are resale houses, and 1/3 of the houses that get sold are new construction. That's the typical mix, 1/3 new construction, 2/3 resale. Right now, it's inverted. It's swapped, right? 2/3 of the houses selling right now are new construction, only 1/3 are resale. So why is that? Because everybody that either bought a house or refinanced their house in the last 3 or 4 years got one of those 3 or 4% mortgages, right? And they don't want to give it up. So there's a lot of people holding back. They don't want to sell their house, even though normally people sell their house. They're like, oh, well, let's get a bigger, nicer house. Let's sell this one and move up to the nicer one. We got a little money. We made a little money in the stock market. Jobs are doing good. Everything's doing good. But they're not. And the reason they're not is they don't want to give up their 3 or 4% mortgage and have to get a new mortgage that's like 7.5%. So all of that supply is being held back off the market. And of course, when you hold supply off the market, what does that do to home prices? Constricted supply, that's an upward thing, right? Upward thing. Now, it's being, the void is made up with new construction. So the new construction is filling the void for all the demand. But something's happening there too. Money is getting a little harder and a little more expensive. And because of that, construction is slowing down a little bit. And if construction slows down a little bit, we keep having babies and people keep moving to Texas. So at some point that supply is going to start to dry up, right? And if that happens, that's another thing that can push prices up. Pending sales trajectory. Pending sales are actually tracking up. So that's kind of interesting. The market started to pick up about a quarter ago. Active listings kind of flat. We're kind of adding more, but we're adding them at a slow pace. So people are really holding back from adding houses onto the marketplace. Again, they probably don't want to give up those mortgages. There's a lot of people kind of on the sidelines. They're waiting for interest rates to come down a little bit so that they can sell their house and move up, right? So there's a little constriction of supply because of that. Months of inventory. Now, in my opinion, this is the number that's the most important number that I look at, months of inventory. What is months of inventory? There's a couple of ways to explain months of inventory, but one easy way to explain it is that if you stopped adding any new houses to the MLS, you just take whatever's for sale and you sell it until the shelves are empty, until there's nothing left. How long would that supply last, right? And that, by the way, that's also the average amount of time it takes to sell a house, right? So how many months of inventory do we have? And the historical trend says this: if there's less than 6 months of inventory, you have a seller's market. If there's more than 6 months of inventory, you have a buyer's market. If there's right around 6 months of inventory, you have a neutral market. So 6 months is considered a neutral market. And if you look at Texas, Texas has 3.4 months of inventory. In other words, Texas is a pretty strong seller's market. Did you know that? Now, this is also perspective. A lot of people are like, well, the market's down. No, the market's on fire. It's just not a 3-alarm fire. It's only a 2-alarm fire, right? Now, a few years ago, it was a 5-alarm fire, right? Now it's just a 1-alarm fire, right? I mean, it's still a pretty hot market. It's just not as hot as it was a couple of years ago. But 3.4 months of inventory, that's not considered a lot of inventory. That's considered by any historical standard to be a seller's market. Housing permit trajectory. Are we building enough houses for all the people that keep having babies and keep moving to Texas? And the answer is we're just keeping up with demand. We should be building a lot more houses, but the problem is money's not easy to get. So we're just barely keeping up with the demand. In-migration. Migration is the ratio of people moving into a city versus moving out of a city. Okay? And for like buy and hold, you always want to go where the people are going to. You want to go where the population is growing, because when the population is growing, that means you have growing demand. That's a big force up on home prices. And of course, we have tons of migration here in Texas. Everybody's moving to freaking Texas. I think California has a program where they pay people to move to Texas. I'm not sure exactly how that program works, but yeah, we just have a crap load of people moving to Texas. So we have huge migration. I don't remember, California lost like 500,000 people, and Texas like picked up 2 million people or something like that in the last census, right? I mean, it's like, and all of those California people, we picked up what, like 4 House seats, and they lost 2 or something like that. I mean, so yeah, they're all moving here. Construction labor growth. Okay, we got a problem. Our contractors are aging out. And for some reason, we can't get our young people to pick up a hammer. So yeah, I don't remember the number, but like the average general contractor is like 60 years old. Like 60. I mean, they're getting old, right? And nobody's getting into that business. So they're getting old and they're moving to Miami to sit on a beach, right? And it's getting harder and harder to get contractors. So don't send your kids to college, right? Give them a hammer and teach them. And by the way, they're going to make a lot more money, right? I remember the story where this neurosurgeon is having a plumber do some plumbing work, and the plumber gives him the bill, and he's like, "Holy crap! This is a ridiculous bill. This is the kind of a bill a surgeon would charge." And the guy's like, "Yeah, I used to be a surgeon, But yeah, send your kids to contractor school, because we need contractors, and that's actually making labor prices go up. So it is housing, building is a lot more expensive. Renovating is a lot more expensive. I remember, I used to be able to build a house for 120 a foot, even 100 a foot in some cases, and now it's like 200, 250. It's just much, much more expensive. And then finally, wild cards. Interest rates could go up or down or anything else. We could have a war, the election, who knows. So those are the things that are pushing prices up, and those are the things that are pushing prices down. And, what is your consensus? What do you think? Do you think housing prices are going, who thinks prices are probably going to start to go up? Who would think the housing prices are going to go up? Who thinks prices are going to start to go down? Okay, well, I could see a lot of reasons that could cause prices to go up. I can't see much that could make it go down. So, and again, I'm not here to try to persuade you of a particular point of view. That's just how we see the market. So let's go into some of the different cities. This is the Texas roll-up. The average price house in Texas, let's see, is $396,000. And that's actually up a little bit versus $385,000 a year ago. Median price is $325,000, which is up a little bit from $319,000. So prices are up a little bit compared to a year ago. This is months of inventory. Remember, months of inventory, 3.5 months of inventory. That's a pretty strong market. Now, it's not as strong as it was a year ago. A year ago is 2.6 months of inventory. That's a crazy strong market. So we're not crazy strong, but we're still a pretty strong market. Listings are up right? There's more houses available. That's why the inventory is up, because there's just more houses available. Closed sales is up, but not much, just really a little bit there. But if you look back over the last 3 years, what happened in the last 3 years? 2021, prices were up 18% in 1 year. 2022, up another 10.7%, almost another 11%. 2023 was flat. So it went up more, and then it just kind of flattened out. And that is what has happened over the marketplace. Now, if you bought a house 3 years ago, you're pretty happy. If you bought a house 1 year ago, you're like, I haven't made any money, right? And that's just a perspective. It feels like things probably started to pick up a little bit about a quarter ago, and we'll start to kind of talk about that because the inventory is starting to come down. All right, let's take a look at some of the different cities, starting with Houston. Here we are in Houston. The average price in Houston is $391,000. It's actually up 3%. And the median price is $220.5, up another 2%. So market's up a little bit. Inventory, 3.3 months of inventory. Pretty good market, Houston. Closed sales is actually up. So something happened. It trended down, and now it started to trend up. Active listings is up. That's why the inventory is up. But pending sales are also up. If you take lease listing, the number of houses available for lease is down a little bit, basically flat. Lease prices are up. A little fewer people can afford to buy a house, so a little more people are leasing because everybody's got to live somewhere. So prices are actually up a little bit, and new lease listings are up 12%. Okay, Dallas. The average price house in Dallas is $476,000. It's up 2%. Median is $385,000, up another 1%. So Dallas is also up. And something is going on in Dallas I'll talk about a little bit. I don't know why, and I don't know if any of you know why, but for some reason, Dallas has always been the bellwether of Texas. I don't know why, but going back 20 years, if you kind of want to know what's going to happen next, you look at Dallas. When Dallas starts to go up, the rest of Texas goes up. When Dallas starts to go down, the rest of Texas goes down. So I don't know why Dallas has always been several months ahead of everybody else. I have no idea. Maybe it's some mix of the economy. I have no idea why. But something's going on in Dallas where inventory is dropping like a rock. It's down to now just 2.5 months of inventory. So Dallas is back into the 3-alarm fire in terms of inventory. Sales is up, closed sales is up, active listings is up, but not that much. Leases are just down 1%, basically flat. Lease prices are down. They just put a lot of new inventory on the market. But pending sales are down, but just a little bit. Now, what happened in Dallas over the last 3 years? In 2021, prices went up 20% in 1 year. 2022, they went up another 15% in 1 year. And then 2023, they went up 1%. Basically, they were flat. So Dallas went up a lot more, and then it flattened out. And now something over the last quarter, inventory is dropping now. When inventory drops, normally that would be something that will push prices up. So we're going to see where Dallas goes next. And there's certain things that are kind of indicators of give you hints of where the market's going to go. I'll give you another example. Condominiums, new housing starts. These are things we look at. We always call condominiums the canary in the coal mine. Condos are the first thing to go. When the market starts to soften, condos are the first thing to go down. They're the last thing to come back. And I'm not saying anything bad about condos. It's just that's where they are, right? And so if condos are hot, if the condo market's hot, everything's hot, right? Because it's if you can sell a condo, you can sell anything. That's the saying. So that's another bellwether, and Dallas is a bellwether. Okay, Austin. Let's take a look at Austin. Now, Austin is an outlier, and I'm going to explain why. But the average price house in Austin, Texas is $553,000. That is not a typo. It's up 0.4%, basically flat. The median price $430,000, down 4.4%. So yeah, 553 average price house in Austin, Texas. Yeah, we actually did a little research on this, and what we discovered is Austin, a lot of you may not know this, where did the name come from? It's actually Latin for San Francisco, yeah. Elon Musk moved to Austin, and Apple moved to Austin, and Amazon set up in Austin. All these high-tech companies moved into Austin, and they brought all their, multi-$100,000 a year employees with them, and it caused Austin to just take off like a rocket ship. So how did it take off? Let me show you the outlier. In 2021, that's the outlier. In 2021, house prices in Austin went up 29% in 1 year. 29% in 1 year. In 2022, they went up another 10%, and then 2023 down 8%. So it went way up more, and then down. Now, perspective, right? If you bought a house in Houston, Dallas, went up 30%, and it flattened out. If you bought a house in Austin, went up 40, came down 10, and flattened out. Perspective, they all went up 30. It's just, where did they go up? It depends on where you were, right? So what happened in 2021? 2021 was an insane market in Austin, Texas, because in 2021, remember months of inventory? In 2021, Austin had 0.4 months of inventory. That's less than 2 weeks of inventory. And what was happening in 2021 in Austin is somebody would put a house on the market, they'd get 11 offers in a weekend. One of them got the house, 10 of them did not get the house. So the 10 people that didn't get the house made an offer on a second house that also got 11 offers. One of them got the house, and 10 of them didn't get the house. And after doing this over and over again, the buyers got so mad at the realtors. What do you have to do to buy a house? I need to live here. I need to buy a house. And it was normal practice in 2021 in Austin, Texas, to buy the house for 5 to up to 10% above appraised value. And if you buy a house above appraised value, the bank will not loan you the money to do that. The bank only loans you enough money to buy the house up to the appraised value. Down payment plus loan equals appraised value, not a penny more. If you want to buy a house for more than it's appraised for, you have to bring additional money to the table on top of the down payment. And in 2021, that was the rule in Austin, Texas. So I would argue that it was normal in 2021, that abnormal market, to buy houses at 5 to 10% above what they were frankly worth or appraised for. And of course, that doesn't go on forever, and it did not go up forever, because once the market settled, it settled down 8%. So perspective, right? If you bought a house in Austin 3 years ago, you made 30%. If you bought it in Houston, Dallas 3 years ago, you made 30%. If you bought it 1 year ago, you lost 8%, and that's just a perspective. But the inventory is now pretty good, 3.2 months of inventory compared to 3 months a year ago. San Antonio, the most affordable city of the 4 big cities in Texas. Average price house is $360, down 1%. Median price, $290, down a little bit more, 6%. Months of inventory is a little higher than the rest of the state, but sales are up. Still a pretty decent market. 2021 average price up, 16%. 2022 another 12%, and 2023 flat. We're really down 2%, which is flat. Lease prices flat, leases up a little bit, 5% year over year. So that is the Texas real estate market and the market drivers. I'll also give you our forecast. Now, again, we don't have we're not trying to persuade you of an opinion, but we're happy to share an opinion. The only thing I know for sure is the future will be different than it is now. But I'll say again, predicting real estate is not as hard as a lot of other things, right? I have no idea what the stock market is going to do, and I have no idea if anybody really knows, right? I don't know what the economy is going to do. But at least in real estate, there's a lot of things we know. I know how many people are having babies. I know how many people are moving here. I know how many houses we have. I know how many houses we're building. I even know how many houses we're going to need over the next year. So we have a pretty good idea of what the supply is and what the demand is. Now, there's a few little variables like interest rates. We're not quite sure what's going to happen with interest rates. We think they're probably going to go down a little bit. But this is our pretty conservative forecast. And by the way, The Texas REIAs has been doing a market forecast for 20 years. Every year we do a forecast. And I'm going to tell you, 20 years out of 20 years, we have been just about spot on every year. Not to brag, but it's not that hard to do a forecast. So the forecast is we're kind of at the bottom of the cycle, probably technically bottomed out a quarter ago. It wasn't much of a bottom. People were expecting a correction. They didn't get a correction. The correction was that it leveled out. That was the correction. So if you're holding your breath waiting for a correction, you may be holding your breath for forever. Interest rates are expected to decrease no later than the summer. And if they do, all bets are off, because any decrease in interest rates is probably going to get a lot more action in the marketplace, and it's certainly going to make things more affordable, which could have a big impact on prices going up. We expect interest rates to drop 1% in 2024. Don't know for sure. That's the consensus. And our conservative forecast is that sales will be up 5% and prices will be up 5% by the end of the year. So that is our consensus. So any questions on this? Was this helpful for you guys? Was this helpful? Yeah. So again, you can make money up markets, down markets, sideways markets. They're all great. Any questions on this data? Question in the back. 2 questions, $5 a question. 6. 6 months is the average. 40-year average is 6 months. So we're in a 3.4 months, 3.2 months, right? It's a seller's market. Yeah. What is the forecast for months of inventory? We don't have a forecast for months of inventory. I would expect the inventory to probably stay about where it is. It's a pretty strong market. I don't know the answer to that, but I can see things pushing up. I can see things pushing down. I would guess we're in a pretty good market. I don't think it's going to get dramatically better. I don't think it's going to get dramatically worse. I would guess it's going to stay about where it is. Yeah. Question?
Trends in Fort Worth, I know there's a lower starting point. They pretty much mirror Dallas.
No, Fort Worth is to Dallas what San Antonio is to Austin. It's kind of Dallas's poor baby brother. I'm just saying, everything in Fort Worth is 2/3 the price of Dallas. Everything in San Antonio is 2/3 the price of Austin. So there's a little more inventory, a little more affordable, a little slower market. I would say it tracks Texas more than specifically Dallas. But they have slightly different industries. They're kind of they're 2 big cities in Texas. So, question.
Depending upon which news feed you subscribe to, there's a lot of talk about the commercial markets.
Yeah, let's talk about, what do you want to know about commercial? What is your question about commercial? Because we also have a whole different group that does commercial.
Okay, so my question is, what do you think the impact of that, if it happens to the financial markets, what do you think the impact is going to be for this?
I don't see that. I mean, so like what if we have problems in commercial, what's going to happen? First of all, I want to make it very clear, commercial is a very broad topic, right? Office buildings, that's just one sliver of commercial, right? There's apartment buildings, there's storage, there's RV parks, there's mobile home parks, right? There's land. I mean, there's so many different types of commercial, hospitality, and then office buildings. I think office buildings are toast, okay? So the problem with office buildings, we had COVID, everybody went home, right? And then the offices kind of moved back, but not everybody moved back, right? I don't think they're all coming back. I don't know, okay? But Amazon's putting big box stores out, and office buildings are losing employees. A lot of people are working remotely. Is that going to change? I don't know. But yeah, the loans are coming due, and we have a surplus of office space, and that's going to cause some problems in the commercial sector. Now, a couple of things about commercial loans. Number one, residential loans are all the big banks. Commercial loans are small local banks. Okay? Yeah. You don't, when you're going to a commercial loan, the State Bank of Texas, the First National Bank of Waco, I'd always drive by those banks like, who the heck bank's there, right? And the answer is commercial, right? They do all the local commercial lending, right? I'm exaggerating a little bit, but for the most part, I remember Silicon Valley went bad and everybody's kind of panicking. The small banks have a bigger problem than the big banks, right? And they're exposed to that. Commercial loans typically are 5-year loans right? Which means that the loans are coming due, and the interest rates, to make things worse, they have to refinance because the loans are coming due, and they have to refinance at higher interest. They got less income and more expense. We're going to have some problems in the office space thing. And I think it's just going to work its way through the market, right? But I mean, I don't see how that affects housing. I don't see how that affects storage. Storage is hot. And apartment buildings are pretty hot. And most of the commercial I don't personally do office space, but most of the commercial investing I'm doing is pretty hot. It's doing really well. And other than some of the banks are going to have a problem with their loans they did to that space, I don't see how that connects to the rest of the market. Yeah. Question. Hurricane Harvey, is that what you're saying? Well, that was a while ago. Hurricane Harvey wiped out 124,000 houses in Houston, so it took a lot of inventory off the market, right? And that should have, been a boom, believe it or not. But there were so many up and down forces that went along with it. But I think Harvey worked its way out of the system a while ago. I don't. I don't know. I mean, certainly, one thing Harvey did is it proved that houses that not in flood zones can flood. Okay, and there was a lot of flooding in Houston. But Houston is unique, and Hurricane Harvey was unique. I mean, Hurricane Harvey was a 1 in 4,000 year event. When a hurricane hits, you always see the same thing. It hits, spins up the coast. Harvey hit and stalled. That doesn't happen. Another front came, it stalled. It dumped 48 inches. Nothing survives that, right? Nothing can survive that. And then if you look at Houston on a map, it's as flat as it can be. In fact, Houston's kind of the drain for about a third of the state, if you think about it. So 48 inches, 1 in 4,000 year flood, I don't expect that will ever happen again. And the thing about floods is it creates stigma, right? When I look at a house in Houston that has flooded, I ask how many times. If it was one time Harvey, I'm thinking it's never going to happen again. Now, if a house flooded twice, it's going to happen again. Okay, so it's always like a one flood or more than one flood, and that's a totally different house in my opinion. But I think most of that's worked its way out of the system. And the funny thing about stigmas like floods, after a while people forget them, right? They just kind of like, flood, does that ever happen, right? And then it happens again. Oh, it's a flood, right? So stigmas kind of go away. Question? Well, I mean, any loan can be, I'm making a generalization. Commercial loans, residential loans are typically 30-year mortgages, usually by big banks, right? Commercial loans are typically 5-year. They could be they could be extended. I mean, I'm making a generalization. But commercial deals are constantly turning over for a lot of different reasons, like a commercial syndication. I do commercial syndications. I raise money, I get a loan from a bank, I buy a property, improve it, and sell it again. When people invest in things, individuals don't want to tie their money up for 30 years, right? They may be willing to invest for 5 years. They don't want to invest for 30 years. So these deals are structured, right, to turn over and over and over, and that creates continuous opportunity in commercial. But when interest rates go up, right, you have properties where the loans are coming due, the interest rates are going up. If the deal wasn't structured right, the deal can then fail. Now, I will say banks don't want the properties back. So in many cases, banks are extending the loans or doing whatever they have to, or they're putting more cash in with cash calls. I believe a well-structured commercial deal should never go bad, although it may go long, right? By going long, I mean, sometimes, 5 years from now when you're planning to sell, the market's not there, so you have to wait. Okay, but you're still getting income and rent, and if your thing was structured well, you can just keep paying the mortgage and keep collecting the rent, keep getting a little cash flow until the market kind of settles back and you can get it sold, right? But if a deal goes bad, I think it probably wasn't structured well. Okay. Question?
Yeah, if you look at some
For submarkets of Houston, is that what you asked for? Well, I mean, I can't name a particular one, but if you're talking about flipping, or are you talking about buy and hold?
Buy and hold.
Well, go where the people are going, right? Go where the people are going. But I would not personally invest, buy and hold in a submarket of any city. If I'm going to buy and hold, I'm going into the inner city. I never want to be in the suburbs. I never want to be in the bedroom communities. I don't want to be in any of those. And the reason is simple. They're still building houses out there. And if you're ever buying and holding anywhere near where they're still building, you're competing with the builder. And it's make versus buy, right? And you're never going to win, right? The values only go up as much as construction costs go up, which is a little, but not a lot. In the inner city, there's no more land to build on. I'm exaggerating a little bit. There's a little land, but not much. You really can't add a lot of inventory to the inner city because it's all built, right? But people keep wanting to move there, and people keep having babies, so you have growing demand with no more supply, and that's where the properties take off. Yeah. Question? Now in those bedroom communities and suburbans there, flip them all day long. There's tons of money to be flipping out there. I just don't hold in those areas. Yeah. On this data that I showed you, a lot of this was pulled from the Texas A&M School of Real Estate, which has some of the best data in the state. We also work with some different economists to pull data. And of course, we use data from all the MLSs. We have these heat maps where we've literally pulled every sale of every house in the state of Texas going back over 20 years, and we map it to show where the highest appreciation spots are. And it's no surprise it's in those inner city neighborhoods. Yeah. Question?
So, going off what he was saying, so like obviously like there's a shortage of homes.
On a national basis and in Texas, we're in a housing shortage, yeah.
So there's lots for sale in the inner city in Houston. Would you recommend buying a lot and developing on it?
Sure. Buying a lot, you know, the question is how much, right? And you know, would I buy lots and build in Houston? Absolutely, but how much, right? And it's just like, if you can buy it for X and build a new whatever on it for Y and sell it for Z, and Z is much better than, you know, more than X and Y, absolutely, right? So buying inner city lots could be a great idea or a terrible idea depending on how much you pay for them.
But would you ever just sit on the land?
Well, you can, that's land banking. And land banking historically can be quite lucrative, but it's also called an alligator investment. What does that mean? It can bite you. The problem with land, it doesn't generate any income, right? And so people buy land, like, you know, and it doesn't generate any income. If you have a loan and you're not getting income, you may have a problem making your loan payment, right? And or you got to have some other income to pay the taxes and carrying costs and everything else, right? So land can be very lucrative, right? Good land in good areas, but the problem is it doesn't generate any income. And if you leverage it with debt, right, then you got debt with no income. That can be dangerous. So, and you never know, right? When the market's softened, land is hard to sell, right? So it's very illiquid in a soft market. Question. But I do want to say one other thing. I consider myself a land banker. I own a bunch of inner city lots that just happen to have rickety old shacks on them. And I rent out the shack to pay the mortgage on the lot. And that's how I think about it, right? Yeah. Two to four units, that's not multifamily, it's residential.
Well, but I'm saying with the multifamily, because they're 2, 3, or 4 duplex, triplex.
Technically, those are all considered single-family houses. Yeah, but
What's the stats in terms of growth and build out of those particular structures?
I don't have that data. I mean, you know, I don't actually know. I mean, I'm sure that data is easy to find, but like, are you saying should you build duplexes? Are they building duplexes? I mean, kind of what's the question? So a couple of tips. I would never buy and hold duplexes or fourplexes, okay? You're always going to get a much better long-term return on investment from single family. 2 houses will give you a much better return than 1 duplex. I don't care where you are. houses do better than duplexes. Duplexes get a little better cash flow. That's true. Much worse appreciation. Over a period of 10 years, where you add up all the cash flow and all the appreciation, appreciation trumps cash flow 10 to 1. So if you're investing in duplexes and fourplexes, you're leaving most of the money on the table. They just don't appreciate like single family houses. So I would never personally buy and hold duplexes. Do I flip them? Yeah.
So then, starting at 5 units and however,
That is commercial. But I'll say something about commercial. I wouldn't buy an apartment building that has less than 50 to 80 doors. And the reason is simple. You have to have, like, depending on the rent, you got to have about 80 doors before you can really afford to pay full-time property management, full-time maintenance, right? So if you have less than that, it's probably a job, right? You're probably helping to manage the property yourself. It's work. It's actually less work, right, and more scalable and more lucrative to own something 50, 80 doors or above, right? And the people that buy these small apartment buildings, they often find themselves, swinging hammers on weekends, and I don't want to do that. So, personally. Okay. Question? In general, I would probably agree with that too. You had a question?
Yeah, so we were just looking at what you presented, coming into the first quarter of 2024. The view of what you've done would have project a model to compound. What would you say?
We expect prices to go up and sales to go up 5% this year.
So like
It's going to go up a little. It's not going to go down. It's not going to skyrocket. It's going to go up 5%. Yeah. I'd be highly surprised if it deviated from that by much. Yeah. So unless something very unexpected happens, which could happen. One more question. Yeah. Okay. So you're in Louisiana, you're coming to Texas, and what's different in the numbers? Houses are more expensive here?
Houses are a lot more expensive.
Okay.
They appreciate at the same rate. Does they appreciate in Louisiana? Depending on the area.
I don't know.
But
Yeah.
they provide a lot more return on the rental. But I know Texas is generally perceived as a ethnic play.
Yeah.
But when I look at the equity, it's just an offset of inflation. So it's not really.
All of my wealth came from equity. I own $30 million worth of houses. I owe $5 million on debt because I've just been buying houses for 20 years and tenants paying off the mortgages while the property doubled in value. And so now I own 30 million and I owe 5 on 30. So I'm $25 million richer, right, from buying rental properties. I think that's pretty good, right? I mean, it's all relative. But I mean, everything's relative. Like you said, oh, houses here are more expensive. I don't know. I know a lot of people that come here from California, they buy houses, buy one, get one free, right? I mean, it's like, it's all relative. And as expensive as you think houses are now, if you could go back 20 years, don't you wish you bought them all? Well, you can't. But as expensive as they are now compared to 20 years ago, 20 years from now, you're going to look at things today and you're going to say, I wish I bought them all. Houses are on sale, okay? And you're selling them at the future price 20 years ago. You can't go back. When's the best time to plant a tree? 20 years ago. When's the second best time to plant a tree? Today. So I would definitely buy and hold real estate long term, right? As much as you can for as long as possible. Well, my guess is I'm not here to compare. I am an expert at Texas real estate. I'm not an expert at Louisiana real estate. But I'm guessing your property taxes are lower in there, correct? Yeah. So you're going to get a little more cash flow and a little less appreciation. But I'm going to tell you, over time, appreciation trumps cash flow 10 to 1. if you look at where the money comes from on a rental property held over a long period of time, if it's in a highly appreciating area, like an inner city area that's growing, over a period of 10 years, you add up all the cash flow, add up all the appreciation, most of the money by a big margin comes from the appreciation. So if your goal is to get wealthy over time, you want a high appreciation property. The appreciation rate? My portfolio appreciates at about 12% a year over 20 years. Now, I own inner city. The average across the state's about 5.6%. So I'm getting about twice the average. And the reason I'm getting about twice the average is because I don't pick houses using the dartboard method. I'm very deliberate. I buy inner city only in high growth areas where the population is exploding and there's no more land to build on. It's pretty simple. Growing demand, no more supply, properties double.